Hello, I'm Brett Winton, ARK Invest's Chief Futurist. Welcome to Big Ideas 2025. We'll be sharing with you a series of key takeaways from Big Ideas 2025. Across all the sections, I'm going to focus on convergence. The convergence between technologies is driving an acceleration in macroeconomic and market growth in a way that we've never seen before. We think this is going to be a historic half decade in innovation and disruption. Why are we confident? Because one, cost declines in computation are accelerating and the compounding rate is increasing. We think that the last half of this decade, driven by artificial intelligence, which can take advantage of cheaper computation in a way that traditional, even computational technology hasn't been able to, will drive profound real-world implications and transformations that you and me and everybody else will feel. What will this look like? Well, the autonomous robotaxis will become a daily fact of life in most countries in the world by 2030 and could become a pervasive mode of transportation for more people as the capability of autonomous robotaxis exceeds human performance in terms of miles driven per accident by as soon as the end of this year. Drugs will be able to be discovered more inexpensively, and so we'll get less expensive drugs on the market that will hit more diseases. This is going to be enabled in part by the fact that AI lets drug researchers do more experiments and test more hypotheses with fewer labor hours. And so simply more experiments will be done and we'll understand the body better, leading to better drug discovery. And in technology space directly, AI will lead to the ability to create custom software on the fly with an autonomous software development agent. And so the entire way in which we interface with technology will transform as software is written to specifically allow us to frictionlessly allow kind of all of the technology pieces in our lives to interact together more fluidly and us to have them do what we actually want them to do. So the acceleration in AI is going to have real, tangible, real world impacts across all of the disruptive technologies that we focus on. And this will impact the underlying rate of macroeconomic growth. We believe that real GDP will compound at more than 7% through the end of the decade as a result of the acceleration in autonomous robotaxis, the pulling forward of the capability of humanoid robots, the radical health benefits, including cures for rare diseases that we think are going to be generated off of multiomics, the utility and use of stablecoins, digital cryptocurrencies, and smart contracting protocols to make the entire financial ecosystem and capital allocation framework more efficient with public blockchains. And in artificial intelligence directly, the transformation in enterprise software and IT that driven by AI will rise to approaching $10 trillion in spend and create tens of trillions of dollars in market cap. And so this macroeconomic acceleration will impact the capital markets and the equity markets as well. We think that more than 2/3 of equity market cap will be attributable to disruptive innovation by 2030, and that 2/3 exposure will breadthen. To date, over the last couple of years, really a handful of companies have enjoyed at least the market appreciation associated with innovation, the so-called Mag 6. We believe that disruptive innovation driven by disruptive companies that are challengers to these incumbents will outgrow kind of that core Mag 6. And so they'll return to their pre-COVID levels in terms of their share of innovation. So it should be an exciting decade. And we believe this is an exciting report. So please enjoy Big Ideas 2025.
Hi, I'm Frank Downing, Research Director for Next Generation Internet at ARK, and this is our 3 main takeaways from AI agents. We think we're in a transition from an era of assistants to AI agents. And these agents can perform longer form tasks for us. They can use multiple tools as they're doing their work and be informed by our personal and our business context. And in doing that, they can accomplish more valuable tasks. So we think that we're going to see more and more productivity advances during this transition from assistants, which answer simple questions, to agents, which accomplish really long-form work and personal tasks for us. And these advances are coming from a combination of improvements in the underlying AI technology fueled by cost declines and actual product development, as some of this research is making it into both consumer and enterprise applications. On the consumer side, we think personal agents are going to be accessible through your existing devices and new mediums like the Meta smart glass form factor that's been pioneered, and that these personal agents will be the first point of contact to products and services that you use every day on the internet. Your agent will search marketplaces for you and find the best products and services and deals in a more personalized and more efficient way than is possible today. And we think in doing so that will create new monetization opportunities as these agents displace some existing traditional search and traditional marketplaces. On the enterprise side, we think software is going to transform the way that we work as AI makes software more superpowered and in a way that can more directly augment human tasks. We're seeing customer service and software development as the two highest value use cases today. But as these models get better, we think that's going to rapidly expand into more and more tasks over time. And companies are already changing their hiring plans to account for this. Not all reducing headcount, but reallocating to revenue-driving hires rather than hiring the same number of software developers or customer support agents they were planning on hiring before. And AI isn't just transforming the way that software works, but actually the way that it's created with this software development shift. And we think that's going to benefit AI-native development platforms disproportionately. Net, we think that business spending on software is going to accelerate throughout this decade, accelerating to a rate of investment not seen since really the COVID pandemic. And rather than lasting for 1 or 2 years, we think this investment cycle will last throughout the end of this decade and well beyond because of the productivity advances that AI enables and how that's going to drive enterprise value. So that's the 3 big takeaways for AI agents.
Hello, everyone. I'm David Puel, Research Trading Analyst and Associate Portfolio Manager for Digital Assets at ARK Invest, and I'll be discussing the Bitcoin section of Big Ideas 2025. So my first key takeaway out of 2024 and going into 2025 is the success of the Bitcoin spot ETF launch in the US. This has been the most successful ETF launch in history. And to give you an idea of why, the cumulative flows into Bitcoin ETF surpassed, at the very least on the first month, every single ETF launch in the last 30 years. And this is about 6,000 ETF launches. On top of that, if you get a sense of comparing the Bitcoin ETF to the gold ETF, for example, you see that the amount of time required for the Bitcoin spot ETF to go over 80 billion or so was about less than 12 months. This is a launch that happened in January. It took gold basically over 7 years to accrue the same amount of value. So this gives you a sense of proportion of how successful and how in demand the spot ETF has been over the last 12 months. The second main takeaway for Big Ideas 2025 would be Bitcoin's volatility. Volatility hit an all-time low at about 42% rolling on a yearly basis. This aligns with our expectations of Bitcoin improving risk-adjusted returns over time. Volatility has been dropping or trending down ever since Bitcoin's inception. pretty consistently, and especially over a long-term time horizon. And last but not least, our three main takeaway in 2024 is, of course, our updated version for our 2030 price targets, end of 2030 to be specific. We last published this in 2023, so after 2 years, we decided it would be a good idea just to update the model a little bit more. In this 2025 model, our Bitcoin price targets are showing a bear case, a base case, and a bull case. So in the bear case for 2030, we have a price target of 300,000 per Bitcoin, which implies a CAGR of 21%. As the base case, we have a price target of 710,000, which implies a CAGR of about 40%. And finally, the price target for the bull case implies a 1.5 million or so Bitcoin price target. This implies a CAGR of about 59%. Now, the way we modeled this out is basically by detecting or estimating the total addressable market penetration that Bitcoin can accrue in different capital cohorts. There's three main TAMs that we include in the model. One is institutional investment, which is a narrative that seems to be picking up over time, especially with the launch with Bitcoin ETFs. This accrues from, it's sourced basically from a TAM that includes the global market portfolio, ex gold. So it's the biggest TAM in the model. The second primary TAM sourcing the Bitcoin price target is digital gold, and the narratives related to Bitcoin being seen as an improved upon version of gold, a more nimble, easier to transact, bearer asset version of gold, basically. The third primary TAM we include is emerging market safe haven, especially out of the M2 of developing nations around the world. We believe that Bitcoin, just as stablecoins, are a good proxy for people in emerging markets to have a defensive position in their portfolio by owning a USD pegged stablecoin in their portfolio. Bitcoin will serve the function of providing volatility and returns to that same portfolio as a way to develop an equity curve for people that usually don't have access to financial services. And then apart from that, we have three, let's say, secondary TAMs out of which we believe Bitcoin will be accruing a lot of value in the next 6 years. The first one is nation-state treasuries. We already see this happening in El Salvador, pretty factually. But on top of that, we believe that there's an emerging narrative at a federal and even state level across the world, and especially in the US these days, that set the stage for incremental demand, potentially by nation states, participating in what could be a sort of space race or arm race, as we saw in the peak Cold War days, but in Bitcoin, in this sense, in Bitcoin adoption, as opposed to any other technological development. The secondary TAM that we include is corporate treasury. We already see several companies, mainly MicroStrategy in this case, leading the way in terms of adopting Bitcoin as a core component of their business model. So Bitcoin in this case not only becomes one of the several assets that a lot of companies may have in their portfolios. It becomes a crucial aspect of the value proposition of the company. And we believe that this narrative, and especially in the bull case, will be very interesting to see play out in the next few years. and see how the MicroStrategy model is replicated in the same or in different fashions by other companies, public and private. And the last source of capital accrual that we believe will be substantial for Bitcoin is the Bitcoin on-chain financial services, or Bitcoin native financial services could be another way to look at it. This is basically what is called Bitcoin layers, or financial services that are put on top of Bitcoin, or that are highly linked to Bitcoin, especially in what is known today as the DeFi world. This includes the Lightning Network, of course, sidechains, and other mechanisms that use Bitcoin as its peg, like wrapped-BTC, which is a token linked to the value of Bitcoin on the Ethereum network. We believe that Bitcoin's on-chain transparency and ease of use will be a main source of demand for the asset in establishing a very robust financial layer on top of the asset in the coming years. So this is basically the way we look at Bitcoin for until 2030. And we're very excited to see what this very robust yet ever-changing asset does in the future.
Hello, my name is Lorenzo Valente. I'm the Director of Digital Assets at ARK Invest. And today we're going to talk about big ideas and the biggest takeaways from the digital asset section. Stablecoins have had a record-breaking year in 2024. If we look at the transaction volume of stablecoins across all the blockchains, they've hit almost $16 trillion of volume. To put this into perspective, Visa hit 13 trillion in fiscal year 2024, and MasterCard 8 trillion. Despite the severe bear market in 2022 and 2023, where we've seen the prices of digital assets go down by more than 50%, stablecoins have really been isolated to this trend and have continued to grow linearly and very steadily over the past 3 or 4 years, breaking almost any all-time high number in terms of active wallets, users, and supply on-chain. Today, the stablecoin market is quite concentrated. The two biggest players are Tether and Circle. Both stablecoins are backed by short-term US Treasuries. And in the blockchain space, these companies have deployed on a variety of blockchains. And really, if we look at the most important metrics of supply and volume, 4 blockchains, public blockchains, really stand out: Solana, Base, Ethereum, and Tron. The second takeaway from this stablecoin deck is the cash flow generation from these stablecoin projects. Whether they are US Treasury backed, whether they are crypto backed, or even backed by popular basis trade, as we've seen with Athena Labs, Tether, Circle, Sky, and Athena, which are really the 4 biggest stablecoin issuers on public blockchains, have really taken most of the revenue from the biggest apps and networks in the space. If we look at combined, they account for more than 50% of the actual revenue of applications and network today. I want to double click on Tether. I think Tether has caught every institution, financial institution, by surprise this year. They've recorded $5.3 billion of net income in the first 6 months of 2024, and they just hit $13 billion for the full calendar year of 2024. To put this into perspective, Tether is in the same order of magnitude a lot of the biggest banks that we have today. Berkshire Hathaway, Bank of America, Wells Fargo, or even giant payment processors such as Visa and MasterCard, with only a fraction of the headcount. Tether has fewer than 200 employees. If you compare that to a lot of these institutions that have hundreds of thousands of employees, this just demonstrates the capital efficiency and productivity of a lot of these smart contract technologies, and really makes Tether one of the most lucrative and efficient businesses in the history of finance. As we were saying before, Tether and Circle and a lot of the US Treasury-backed stablecoins are holders of short-term US Treasury debt. If we combine Circle and Tether as one entity, they would be the 20th biggest holder of US Treasury debt in the world. And we believe in the coming 5 years, as we model the growth of stablecoins, they could hit 1.5 trillion of supply, and we could very much end up having one of these companies as one of the biggest holders of US denominated debt in the world. The last takeaway of stablecoins is really on the innovation side. We have seen tremendous demand for US denominated stablecoins in populous emerging markets around the world. Brazil, Argentina, Turkey, Indonesia, a lot of these countries need US denominated collateral and savings. And we're seeing innovation on the stablecoin side to try to pass on some of the risk-free yield rate to the stablecoin user. This is really a sector of stablecoins that has grown tremendously in 2024 with different mechanisms and risk profile. But we believe that will continue to grow tremendously in 2025 as a lot of users in these emerging markets want to have access to the US dollar, but also the risk-free rate. Moving on to scaling blockchains, this also has been a pivotal year for these technologies. We've had one of the biggest technical upgrades on Ethereum, cutting the cost of transactions on layer 2s, which are blockchains that allow for cheaper and more efficient transactions, to cut the cost by almost 10 to 20x. And this has had two very direct consequences. We have seen the user base on Ethereum go from the Ethereum base layer to these layer 2s to benefit from lower costs of transactions. And now, if we look at the market, more than 85% of the transactions on Ethereum take place on these cheaper layer 2s. The other very direct consequence is that this has spurred tremendous activity overall. And we've really seen the number of transactions of the overall ecosystem skyrocket in the last year. Double-clicking at layer 2s, the biggest story in 2024 has been Base. So Base is the layer 2 network incubated and designed by Coinbase, the centralized exchange. And they have, by all metrics, if we look at active users, number of transactions, and revenue generated, Base has really taken all the oxygen out of the room and accounts for more than 50% in most of these very important metrics of layer 2s. As we talked before with Tether and efficiency in the smart contract land, this has been a pivotal year for decentralized applications and decentralized networks. If we look at the spot volume of decentralized applications of public blockchains and derivatives volume, they have gained tremendous market share compared to their counterparts, starting at 8 and 3% at the beginning of the year and more than doubling that. And today, in January, we're seeing the spot volume almost hit 20%. On the centralized counterpart market, we have seen Binance lose a significant market share in this last year, with Bybit and OKX and other centralized exchanges taking some market share from Binance. Talking about efficiency of smart contract ledgers, we've taken a look at the biggest spot trading venues on public blockchains, such as Radium, Uniswap, Orca, Aerodrome, and compared those to their centralized counterparts, such as Coinbase, Binance, or OKX, for example. And it's really impressive. We see that the decentralized counterparts are 5 to 10 times more efficient than the centralized exchanges, with protocols and companies with fewer than 100 employees doing the same order of magnitude of volume as centralized exchanges that have 4, 5, 6, or even 10,000 of employees. I want to wrap up this scaling blockchain part with Solana. Solana has been really the biggest comeback story of 2024, with the price of the token at $8 in the depth of the bear market. We've seen a tremendous turnaround of Solana, with really a focus on the base layer, with strategic trade-offs and a high-performance design. Solana now does 4 to 5 times more transaction throughput than Ethereum and its layer 2s combined, at almost 800 TPS. And in many metrics that we analyze and we follow, and fees, revenue, and active users, Solana is really competing now with the likes of Ethereum and even Bitcoin to really insert itself on what we could call a top 3 and a big 3 of the digital asset industry. This really has been emphasized and highlighted by the developer community, and the trends that we've seen in 2024. When we look at the net new crypto developer, Solana has taken the first place over Ethereum, and we're seeing a lot of founders and developers wanting to develop their smart contract and launch their product first on Solana. Base is now the biggest layer 2 on Ethereum in terms of active developers, and has inserted itself in the top 5 of blockchain with the most net new crypto developers. And as these blockchains continue to grow, we believe then that Solana and Base will attract even more users in 2025.
Hey everyone, I'm Tasha Keeney, Director of Investment Analysis here at ARC.
And I'm Daniel Maguire, Research Analyst on ARC's Autonomous Technology and Robotics team.
And we're here to share our top 3 takeaways for Robotaxis. So first, we'd like to point out that although Robotaxis have been talked about for over a decade by automakers and by ARK Invest, they're late, but they're here already. And we're really excited about this year in particular, and we'll tell you why.
To Tasha's point, Robotaxis are already here. We estimate Robotaxis are completing over 12 million rides on an annual rate. And while Waymo leads in America, we believe that Tesla's data lake and proprietary data advantage should give it a competitive edge when it launches its autonomous ride-hail service in Austin this June.
So while Waymo launched back in 2018 for commercial service, Tesla, as Daniel mentioned, plans to launch this year. And we're excited because this could be the year of robotaxis actually scaling. We believe that Tesla has an inherent cost advantage because it's a verticalized manufacturer that's helped with its capital cost, which has a meaningful effect on the cost per mile. And because Tesla's rollout strategy is not geofenced, we also think that they could have a scaling advantage over competitors. So we're super excited for the launch later this year. Ultimately, we think that robotaxis could be a $34 trillion enterprise value opportunity. As we've mentioned in the past, this is one of the largest opportunities that we see in the AI space, and this is the first mass-scaled example of embodied AI that you and I will experience. If you haven't ridden in a Robotaxi, get out there and test one in one of the cities in the US that has them today. And now our top 3 takeaways from autonomous logistics. In this space, we see the cost per delivery or cost per ton mile coming down across trucking and smaller robot form factors like drones or integrated traffic robots or rolling robots. We think that roughly there will be a 60 to up to over 90% reduction in cost compared to human-in-the-loop systems today. For delivery systems, this will totally change consumer behavior.
Coupling the lower cost of delivery with residential drone deliveries taking off this year, safety drivers being removed from autonomous trucks, and rolling robots continuing to expand beyond college campuses, we estimate that global delivery revenue could be approaching roughly $900 million by 2030.
And one more thing, in the defense space, costly manned aircraft are a thing of the past. This year we expect to see much more of a focus on low-cost AI-powered drones. In fact, we're already seeing a lot of exciting developments in that space, so stay tuned.
Hey everyone, my name is Sam Corris and I direct ARC's Autonomous Technology and Robotics Research, joined by Daniel, who you met earlier in the video. Right now we're going to be diving into energy and that big ideas section. A lot going on, a lot of news because of AI. But I think the first thing to say here is that more energy is good. We believe that, and we think that it can and will be used productively. And so we are not looking for cutting of energy. We're looking to build more and more energy to fuel economic growth. And I think an interesting thing to look at just from a broad context here is that if you look at electricity prices in the US from the late 1800s through 1974, costs were consistently falling, aside from World War II. And then they stopped and began to plateau and even rise in 1974.
We believe that is by no coincidence the same year the US Energy Reorganization Act was introduced, which created regulatory hurdles for nuclear energy. And before this, nuclear construction costs were following a Wright's Law cost decline curve, and post 1974 is the nuclear that most people are familiar with, that is often over budget and delayed in its timelines. So fast forward to today, there is now significant bipartisan support to reignite the US nuclear industry. There is a certain craze around nuclear, particularly small modular reactors, which promise faster construction timelines and streamlined regulatory approaches, amongst other benefits. And this is notable in the last couple of months. You've seen AI hyperscalers turn to nuclear as a clean source of firm power to help power their data centers that they're building out with, but also manage their net zero commitments that they made previously in advance of perhaps the anticipated power ramp up needed to train these large language models. However, to triple nuclear capacity by 2050, as the US intends to do, we believe that there must be a combination of large reactors, small modular reactors, and micro reactors, so across the full size scale, with each offering unique benefits for its end use case. Currently in the US, we estimate there's over 30 reactor designs being developed, and we think it's important to down select from those and reiterate on the similar designs to help reignite this Wright's Law cost decline curve that existed for nuclear in the 70s. And why is this important? Well, reigniting that Wright's Law cost decline curve can help make nuclear become cost competitive again, particularly relative to solar and wind. Nuclear has the benefit of having a higher capacity factor, meaning it doesn't suffer from intermittency issues. It's often heard that the sun doesn't always shine and the wind doesn't always blow, so nuclear offers a great solution for that. And the net of all of this is to lower electricity costs. So that is kind of our high-level stance on fission. And just to note, we're often asked about nuclear fusion, and there's always the joke that it's 30 plus years away, but this is an area where we think there still remains significant scientific hurdles. And even once those hurdles are achieved, if fission's history is any guide to go by, it's likely to be a decade plus before any commercial fusion plants are brought online. But with all of that on nuclear, we think nuclear won't solve all of the problems. And Sam, I know you want to dive into solar and batteries as well as wind.
Sure, and I'll give a shout out here to Akash, the associate on our team who did a lot of this work as well. Right, Daniel, you mentioned intermittency, and this is often what people call out when you talk about solar. But with the cost declines we're seeing in batteries, we're actually getting to a point where solar plus batteries can get you to a very compelling levelized cost of electricity for 90% uptime. To go from 90% to 100% uptime, there's a kind of elbow in the curve of cost. And so, over the next 5 years, as battery costs continue to come down, that will come into range. But this is just to say, nuclear, solar, wind, batteries, we think the energy landscape is changing. Often when we talk to people, they don't appreciate how quickly the landscape is changing because it's somewhat out of sight, out of mind. But this, I believe, is happening much more rapidly than people anticipate. You can even tell from Tesla's earnings calls just the rapid growth in stationary energy storage and the, according to them, insatiable demand that they're seeing there. So it's an exciting time. The whole story is not just AI driven, but really, all different types of technologies requiring energy for the future, with AI being that near-term catalyst. Right now, we're going to dive into the robotics section of Big Ideas with the tagline, decoupling physical labor from output. I really think this is the best way to understand automation and robotics from a high level throughout history, really. It's how do we separate the effort that we put in as humans from what we get out of it, right? The tractor, a classic example there. Without it, far more people would be working in agriculture than they currently do. And I think an important framing here is to understand that with automation, it transforms and creates industries that we would not necessarily predict ahead of time. So you have a classic example. Most people have access to this, is a washing machine. And so before washing machines, it would take roughly 15 hours to do laundry. And this is not to say that people spent 2/3 of their day doing laundry, but rather, you wash your clothes every couple of months, every few months. And as you start to automate this and you bring it down and you have people spending, 2 hours a week doing laundry, you create industries that you wouldn't have otherwise expected, right? The fashion industry is somewhat based on the fact that you can wash clothes quickly. You've got the washing machine service and sales and the more directly tied ones there. You can think of, auto manufacturing as well, pre and post assembly line, right? People were selling cars before the assembly line, and this massive reduction in input to output via the assembly line created a massive industry that still exists today. So, I think that's good to have in the back of the mind as well. When we're looking at opportunities today with robotics, what makes this so exciting? I think if we went back 5 years, a lot of people would say that there were serious hardware limitations for robotics. And, we hear some of that today, but really robots are converging with artificial intelligence, AI, various models, computer vision, and the limit on robotics now seems to be software gated. And that's super exciting because of how quickly software is moving. And so what we're seeing right now is this idea of humanoid robots or generalizable robotics. And we think that this could be a $26 trillion global revenue opportunity in the long run here. And we think that's roughly split equally between household robotics and manufacturing. I think an important thing to understand here, though, is that the introduction of these is not going to be all at once, right? If you introduce a robot that is just as capable as a human, then it almost doesn't matter what that robot costs, right? If you look at the hourly wage plus benefits of a worker in the US over 10 years, that's roughly the net present value of that is roughly $550,000. So you could imagine that a robot that is as good as a human could be worthwhile paying $550,000 for it. I think the reality, though, is we're going to see this gradual curve of performance. And so it's saying, if a robot can boost productivity by 2%, 5%, 10%, what is it worth paying for? And I think a unique thing here with a robot versus a autonomous vehicle is that a robot can do a task, not necessarily a full job. So an autonomous vehicle really needs to do the full job. You can't say, this car can do the one task of turning right, and that's great, and that's a huge benefit, right? It's like the unlock for autonomous vehicles is it being able to do the full job, not just lane keep on a highway, not just turn right or make blind lefts. You want it to take you from point A to point B. With robotics, especially in manufacturing, you can isolate a single task and there can be a huge opportunity there. And then, lastly here, I'll say there's a constant fear of robots taking humans' jobs. The reality, at least historically, has been that it's actually created enormous opportunities and taken non-market activity and turned it into revenue generating activity and GDP. And so, mentioned the tractor at the beginning, I'll come back to it now. Of the 82% of people who, quote, lost their jobs between 1950 and 2000, almost all of those farm workers were unpaid family members who were then freed up to join the labor force and contribute in a different way. And so, there will certainly be displacement, but I believe that, we're not talking about total destruction of jobs here. And so moving on to reusable rockets. What is the key takeaway here? This is an industry that is defined by a dramatic cost decline that's changing the business model, leading to an enormous opportunity. And so we'll walk through each one of those quickly. So if you look through the late 1990s through the early 2000s, rocket launch costs were actually increasing. There was a duopoly and in the US, and then we were relying on Russia for launches as well, and costs just kept increasing. Then you had SpaceX enter the scene and say, we're going to reuse rockets. And everyone said, that's a crazy idea. It's not economic. We've tried this before. It was way over budget. But SpaceX broke the mold here, landing the first rocket in 2015, reusing it in 2017. And since then, no other company has reused an orbital rocket. And so this is essentially a 10-year lead for SpaceX. And during that time, they've managed to consistently bring down launch costs as they've gotten better at refurbishing and reusing these rockets in shorter time spans. That's not to say there aren't people who are now, sold on what they've done. You've got a handful of companies now that are seeing the light that reusable is the key to dropping these launch costs. But so then, what do these lower launch costs enable? They change the business model and where people are choosing to send things in space. So if you looked back to, the early 2000s, people were launching things to geosynchronous orbit. And so these are, this is roughly 22,000 miles above the Earth, very far away. And so, what's the benefit of that? You got a satellite up here, it covers a third of the Earth. You send up 3 of these massive, extremely expensive satellites, and you've got global coverage. The downside is is really only good for broadcast, because the amount of time it takes for data to go from the Earth to that satellite and back is quite long. And so it's high latency, not great for a lot of applications. And low Earth orbit, which is, just a few hundred miles above the Earth, like right here, is now opened up by these declining launch costs. And why is that? Well, if you're putting a satellite right here, one, it's constantly moving relative to its place on the Earth. And since it's so close to the Earth, it's only covering a very small area. So instead of launching 3 for global coverage, you need to launch dozens to thousands to tens of thousands, which would be quite uneconomic if launch costs were still high. So it's opened up this new area in space with low latency. And that's what we see with Starlink, right? You can get incredible high-speed internet from these LEO satellites that are circling the globe. And so this is opening up a huge business opportunity. This is what we were talking about. So we think this is a $130 billion in annual revenue opportunity. So huge opportunity, that breaks up into a handful of different things. The biggest item here is global broadband and direct-to-device capability. So what is direct-to-device capability? That's taking a smartphone and having it be able to connect to a satellite. And this isn't necessarily replacing a traditional telco today, but it's giving you coverage, emergency text capability if you're off the grid. And we think, it was actually surprising to us to see T-Mobile come out and say, this is like $10 to $20 per month. We think that, as this rolls out across the globe, we think, this is going to be bundled into a lot of offerings over time. And we think, at 50 cents a month, 8 billion, cell phone subscribers are going to be paying this. And that's a $48 billion opportunity. And then the other is, the Starlink opportunity, which is access to broadband for individuals, businesses, airlines. And just on the to household side of it, we think that's a $40 billion opportunity. Then you add in RVs, boats, aircraft, ships, and that makes up the difference, getting us to that roughly $130 billion opportunity. So there you have it. Why is space so exciting? We've got cost declines for the first time. We've got those cost declines opening up a new area of space and a new business opportunity. And that business opportunity is in the $100 billion range.
I'm Nemo, and I'm the Multiomics analyst on our team. So today I'm going to talk about Big Ideas Multiomics section. So we profoundly believe that healthcare is undergoing a profound transformation. The convergence of AI and multiomics is shifting us from today's reactive, sick care model to proactive, curative healthcare system. Multiomics tools, those that allow us to read and write biological information, are driving this revolution, enabling us to, number one, decode biological complexity at unprecedented speed and scale. Number two, deliver precision diagnostics for earlier and more accurate disease detection. Number three, develop cheaper, faster, and more effective drugs using AI. And number four, build curative therapies that move us beyond chronic disease management. So what do we see as catalysts of change? So number one, falling costs in DNA sequencing and synthesis. DNA sequencing costs have plummeted by staggering 10 billion fold in 35 years. While we believe that DNA synthesis costs by 2030 are gonna drop by 10 million fold. The reduced cost of reading and writing biology are making personalized medicine at scale a true reality. This then enables explosion of biological data, and using AI as an engine, we can actually make sense of this data. Just to illustrate this, the productivity of genomics analysis has skyrocketed. Today, we can analyze 1.4 billion genomes for the cost of one genome analysis in 2001. For the first genome that we have sequenced in 2001, it took us 180 days to do analysis. Now we can do the same analysis in 10 minutes. So multiomics tools generate massive data streams fueling AI models that can decode biology, optimize diagnostics, and design better drugs. And then, as I was mentioning previously, we believe that true kind of engine here is the AI, and that AI will enable different applications for this data. One of them is being drug discovery. To illustrate this catalyst, we believe that the emergence of the virtual cell foundation models and AI-driven simulations allow us to conduct in silico experiment and scale. Virtual cells, powered by single-cell genomics and AI, are transforming drug discovery by simulating biological functions and predicting drug response in real time, much like AlphaFold did for the protein structure prediction. So how do we see that this evolution of the healthcare is going to happen? So we believe that it's going to move from the diagnostics with AI drugs to curative kind of therapies. So when we talk about molecular diagnostic, it is important to mention the first wave of this revolution has enabled earlier disease detection and tools like minimal residual disease testing, which can detect cancer recurrence up to 20 months earlier than the traditional imaging. Multi-cancer screening, which is another blood test, or how it is called in space, liquid biopsy, is reshaping cancer detection by allowing us a single blood test to screen for multiple cancers at once, vastly improving early detection rates and cutting the costs. When we talk about AI drug discovery, it is important first here to mention that AI-designed drugs are already demonstrating higher efficiency, lower costs, and faster timelines. Self-driving labs, which combines multiomics, automation, and large language models, could reduce drug costs and timelines by 200-fold productivity gains, with companies like Recursion Pharmaceuticals leading the charge. So when we are talking about further drug discovery, what we believe that is really can change how the drug discovery is done is actually revolution that's happening in the preclinical research. Now technologies like organs on chips can provide better predictive models, reducing reliance on traditional 2D cell systems and animal testing. Integrating AI with these advanced preclinical models will dramatically improve success rates in drug discovery. Further, what is important to note here, we really believe that AI is going to transform how the drug discovery is done, and that's going to be also transforming the economics of the drug development. So, as I was mentioning before, AI really enables us faster timelines and lower costs. To illustrate this, we believe that AI could reduce drug development time by 40%, so from 30 years, which is the standard now, to 8 years, and cut costs by 4 times. Today, we believe it's about 2.4 billion, and we believe that it can go to 0.6 billion in the future. This will then lead to higher returns on investments. So faster commercialization extends patent-protected revenue, boosting drugs' lifetime value by 30 to 80%. AI-driven drugs could generate up to 4 billion in cumulative cash flow compared to less than 1 billion for traditional drugs. And the important thing to note here is that in addition to AI drug discovery, we believe that there is another kind of catalyst here to mention, which is the value of cures. AI drug discovery could enable the development of the curative therapies much faster, shifting the industry from disease management to outright eradication. The average price of a cure today is 15 times higher than a lifetime of disease management, and capturing revenue up front could make cures 20 times more valuable than traditional treatments. So, what is the future of the healthcare? We see a bifurcation in the industry as AI and multiomics revolutionize drug discovery and precision medicine. Companies that fail to adapt could face obsolescence. A clear divide is emerging. AI-driven cure-seeking firms will pioneer the next generation of medicine. Traditional pharma biotech companies rely on outdated models may struggle to compete.